The future is global, green and digital. Luxembourg is ready for it. By 2025, Luxembourg's ambition is to finance a sustainable future, putting qualitative growth, innovation and stability at its core. Now, more than ever, financial services are essential to economic recovery. For decades, Luxembourg's multi-jurisdictional expertise has helped connect global investors with firms and projects in need of financing anywhere in the world. Located at the heart of Europe, Luxembourg will further expand its role as an EU hub for companies, thereby supporting a stronger European economy, job creation and qualitative growth at home and in the EU. At the forefront of green finance for several years, Luxembourg has not only embraced the global trend towards sustainable finance, but has taken on a leading role. We will continue to strengthen our position as a key hub for impact investment and blended finance. Drawing on a long history of innovation, Luxembourg is committed to fostering new ideas and companies by providing a rich, supportive environment for today's fintech pioneers. It is leading the way for the future of finance. A stable country with a strong economy, Luxembourg is committed to ensure compliance with international standards and continues to provide international investors with the highest possible standards of protection. Our unique pool of multilingual and highly skilled talent provides the key to unlock Europe's large and diverse single market. Luxembourg will support the continuous expansion of its financial industry, and in doing so, is steadily building a first-class financial services industry that benefits Europe and the world. We're financing a sustainable future.
Welcome to the Sustainable Finance Forum, bringing together key sustainable finance experts from across the world to share their views on how finance can shape a sustainable future.
Good morning, good afternoon, and good evening. Wherever you are in the world, a warm welcome to the third edition of the Sustainable Finance Forum Luxembourg. My name is Judith Bogner. It's a great pleasure and honor to lead you through the conference on behalf of Luxembourg for Finance. Now, as you can see, owing to COVID-19, we have turned the analog conference into a 3-day digital experience with a purpose-built studio in the Chamber of Commerce here in Luxembourg, and we're very grateful to the Chamber of Commerce that we're allowed to use its facilities. We're also very grateful to our media partners and sponsors whose support allows us to facilitate the conference. We're also very grateful to our more than 20 speakers who will share their insights over the next days with us. And we appreciate all of you who are joining us from around the world. We have more than 1,000 registrations from more than 60 countries, so truly a global community coming together for the vital topic of sustainable finance. A quick heads up, we want to bring you in, of course, interactively with 2 digital tools. If you scroll below the stream window, you see a Q&A tool you can use to send questions to the panel later on, and also a Slido polling tool which will activate also during the panel discussion to ask you a question and feed that into the panel discussion. We do not have a Q&A for our keynote speakers, but you're welcome to reach out to them directly. Their bios are integrated in the event website with their contact details. And also, last not least, I should remind you that everything will be recorded, so at the end of these 3 days, you can double-check the content again on the event website of Luxembourg for Finance. And also, I want to invite you to tweet and comment about the conference on Twitter and on LinkedIn, and to that effect, use also the hashtag SFFL20 for the 2020 edition of the Sustainable Finance Forum, and the Twitter handle of Luxembourg for Finance @LuxFinance. So we can all see your comments and share them around. Now, at the 2018 and 2019 edition of this conference, if you happen to be with us here in Luxembourg, our conversation was a lot about how sustainable finance was outgrowing its niche, how investors were embracing those green bonds and social bonds and blue bonds, and impact investing was becoming the fastest growing asset class, and regulation was being developed. But this year, in 2020, there's a noticeable shift, a momentum for sustainability, and it ties in, of course, with the COVID-19 pandemic. in two ways, I should say, because of its social and economic impact on livelihoods in so many communities. Many countries are mobilizing funds to mitigate the impact, and that has amplified the social aspect of sustainable finance. Think, for example, of those COVID-19 bonds. And just last week, the EU made bond market history when it issued the first chunk of its SURE social bonds and drew the largest ever order book because it was 14 times oversubscribed, which ties in with the financing of its emergency unemployment program, again, which ties back to the pandemic. And the second driver, if you will, for the momentum for sustainability is as leaders in business and politics are dealing with the impact of the pandemic, there is the general realization that we are facing a yet bigger systemic crisis, and that is the climate crisis, compounded by a historic loss of biodiversity and ecosystem degradation. So action is needed, and this is why China just recently committed to go carbon neutral by 2060. And just yesterday, Japan joined the commitments to go carbon neutral by 2050, which is in line with the goal of the European Union. And large IT companies, the likes of Apple, Microsoft, and Amazon, also have committed to be carbon neutral by 2030. Yes, as a result of the pandemic, there will be an economic downturn. The IMF expects a contraction for the global economy of 4.4% for 2020. But as trillions are being mobilized around the world, there is almost a clarion call going round to use the momentum and make sure that this recovery is a sustainable, a green, and an equitable one. In the words of Kristalina Georgieva, head of the IMF, she says this is a new Bretton Woods moment with three imperatives, according to her. Implement the right economic policies, invest in people, and tackle climate change. Which leads us to the theme for our first conference day. So where are we in this process in regards to developing sustainable finance, also in light of COVID-19? What are the changes and the challenges, and what is necessary to keep that momentum going and push even further? And so, to kick off our conversation on our first conference day, it is a great honor to welcome and introduce to you as first keynote speaker the former Secretary General of the United Nations, Mr. Ban Ki-moon. As you may know, ever since he started serving in this role back in 2007 until he stepped down at the end of 2016, he worked tirelessly to shift the global agenda and put climate change at the top and move the global will to move to a more sustainable system. Under his leadership, the global community conceived what we know today as the Paris Climate Accord and the Sustainable Development Goals. Today, he speaks to us as president and chair of the Global Green Growth Institute about why he thinks sustainable finance is key to achieving those goals.
Your Excellency Pierre Gramagna, Minister of Finance, Mr. Nicolas Markel, CEO of Luxembourg for Finance, distinguished speakers, experts, and participants of the forum, ladies and gentlemen. I would first like to thank you for inviting me to address you on this special occasion, the third edition of the Sustainable Finance Forum. While I cannot be with you in person, I am nevertheless very pleased to join you by video to give my full support and stress the importance of innovative financial ideas to fight climate change and accelerate the transition to the green growth model of inclusive and sustainable development. As the former United Nations Secretary General, who oversaw the formation and adoption of the 2030 Agenda and its Sustainable Development Goals and the Paris Climate Change Agreement, it should come as no surprise that I applaud Luxembourg's commitment to the goal of transforming itself and assisting other leading financial centers to a sustainable global economy. Luxembourg's climate finance strategy, with the dual objectives of contributing to the international response to the climate crisis and cementing its role as an international hub for climate finance, deserves recognition. For such a small country with an area less than 1,000 square miles and less than 700,000 people, Luxembourg is certainly punching above its weight, and its ambitions and contributions to the fight against global climate change are nothing short of admirable. I am therefore very proud that the Global Green Growth Institute, GGGI, has partnered with Luxembourg's International Climate Finance Program to support climate mitigation and adaptation in Senegal, Vanuatu, and Vietnam. Luxembourg's current position is a result of its keen awareness of the fact that green finance is a key to impacting sustainable outcomes, and GGGI is proud to collaborate with Luxembourg. Another institution that is well aware of this fact is the Green Climate Fund, GCF, a fund established within the framework of the UNFCCC and one of GGGI's close partners. In order to have a substantial impact against the climate crisis, it will be critical for Luxembourg's ICF, GCF, and many other institutions to continue to move forward and provide flexible and concessional long-term assistance to support developing countries that are facing financing gaps in their respective efforts to achieve the Sustainable Development Goals. Now, many of us expected that the year 2020 would be the year of action for combating climate change. But with the unexpected COVID-19 pandemic, the world as we knew it changed in an unprecedented way none of us could foresee. The pandemic has exposed weakness in our economies, changed the way we work and study, and forced the governments around the world to reprioritize and rethink their policies in order to prop up their economies and communities. None of us in the world have been immune to its impacts, and I'm sure we all have stories and experiences to share. The global poverty rate, which was previously projected to drop by more than 8%, is now projected to increase by nearly 9% due to the COVID pandemic. However, every challenge presents an opportunity. As we try to recover, we should seize the opportunity to build better than before by shifting our economies to the green growth model of sustainable, resilient, and inclusive growth. GGGI recognized this opportunity in the early months of the COVID pandemic. By spring of this year, I wrote to the heads of states of GGGI members to share concept notes on greening recovery packages. And as more world leaders and their governments are made aware of the opportunities to accelerate the transition to a green growth economy and to bridge the gap to the Paris Agreement targets, sustainable finance will play a key role in mobilizing the necessary amount of capital to deliver on the policy objectives under the Paris Agreement and the SDGs. The financial sector is in a unique position to incentivize the green transition. For example, institutions can agree to lend to, invest in, or otherwise support firms that are willing to manage their climate risks and impacts, which has a strong financial benefits as well as broader social benefits. For these obvious and rational reasons, sustainable finance continues to gain significant traction. The path of going from billions of dollars to trillions of dollars in sustainable investments will be led by those that understand this, such as Luxembourg and the European Union. If we seize these opportunities without delay, in an ironic twist of sorts, the year 2020 can be the year of action for combating climate change. But we have to act without delay to reverse the current trends. Affordable green alternative sources of energy are available today, but the capital flowing into fossil fuels and other unsustainable sectors still outweigh greatly the investments that go into sustainable practices. This short-sighted failure to integrate climate change factors into decision-making process creates unnecessary risk for financial capital and institutions. We, as a global community, can pay modest sums now or immensely larger sums later. As a result of inaction, we, as a global community, can support each other with collaboration, innovation, collective resources, and coordinating among governments, businesses, and other stakeholders. We, as a global community, need to act together and now, before it is too late. How well we work together or not, and how well we seize the opportunity out of the challenges will determine how history remembers us for generations to come. I hope the Sustainable Finance Forum will be the setting that serves as an impetus for the rest of the world. Once again, I thank you for the invitation to address you today, and I wish all of you a very safe and successful forum. Thank you.
Thank you so much, Ban Ki-moon, for your voice, for your continued efforts as champion for climate action and sustainability, and your rallying call for global collaboration. And as you just heard the former Secretary General of the United Nations say, Luxembourg may be a small country by numbers, but it is punching well above its weight as a pioneer for both financial innovation and sustainability. It is the leading European domicile for responsible investment funds. It is also home to the Luxembourg Green Exchange, the LGX, the world's first and only platform for sustainable green and social securities, and it lists half of the world's green bonds. It is also the first European country to give itself a sustainability bond framework in line with the European Green Taxonomy. And to tell you more about Luxembourg's sustainability agenda, I have the pleasure to turn it over now to Luxembourg's very own Minister of Finance, His Excellency Pierre Gramegna.
Excellencies, ladies and gentlemen, it is a pleasure and a privilege to be addressing you on the occasion of the third Sustainability Summit here in Luxembourg. I would have loved to welcome you all personally, but a tiny little virus has decided differently. Let me welcome all of you and give a special appreciation to Chairman Ban Ki-moon as a Global Green Growth Institute chairman, who has addressed us just before I speak to you. He, being the former Secretary General of the United Nations and being from Korea, already highlights in what way green and sustainable finance is an issue that covers the whole planet. I remember very well last year we had Dr. Ma Jun with us from China, illustrating again that saving the planet, having sustainable finance is an issue that is of the interest of the whole global community. I would like to say that the pandemic, in a way, is a kind of life-size test of the importance of saving the planet. At the time when there was a partial lockdown basically all over the world, and especially in developed countries, we could see how human activity has impacted the climate and the planet. So we definitely need no additional proof to act, and I'm glad that sustainable finance will be an important part of this. Now, in the context of this global crisis of the pandemic, more than $12 trillion have been invested by different countries to amortize the economic and social shock. Now, we can learn from this. Obviously, this is a huge cost, but there's one mistake we shouldn't do, is repeat the errors of the past. So the recovery must be smart. We need to build back better and more social and more green. So I have three priorities that I would like to share with you. The first one is that sustainability means to be green and social. What do I mean by that? I mean, we should have in mind the welfare of the planet, but also the welfare of our people. Now, Europe has given lots of examples of this. I think of the SURE program that we will finance and are financing to ensure that we save jobs and make sure that we save jobs in the future and do not lay off people. This SURE program is worth 100 billion euro, and the EU Commission is going to implement that in the coming days, also building on the relationship with Luxembourg in this context with the Luxembourg Green Exchange. Now, second, I've experienced it myself here in Luxembourg when we introduced or plan to introduce the carbon tax next year. Carbon tax is good to save the planet on the one hand. On the other hand, you must amortize it and reduce the impact for the low-income people. So we have decided to foresee a tax credit for lower earners and lower revenue people. Third, use the revenues that you get from such taxes for two specific reasons. One is to do a social amortization on the one hand, and the other hand is to make sure that the money that you collect is invested in green projects that save the climate. And last but not least, we issued a month ago a sustainability bond here in Luxembourg, which is the first of its kind, building on the fact that we have given ourselves a kind of framework for sustainability that is compatible with the taxonomy of the EU, with the ICMA standards, and has as a goal to reach the Sustainability Development Goals of the United Nations, a pin which I wear every day, because I really believe that this is a common feature, a common goal that we all need to achieve. The second priority in my mind is that we should all do this together in a multilateral framework. Europe has led the way in this sense, basically by agreeing as early as beginning of April on a couple of emergency measures to compensate and to organize the response of Europe towards the COVID crisis. I've already mentioned the SURE system for remote work and for partial unemployment on the one hand. Second, we have the guarantee scheme of the European Investment Bank. And third, we have made sure that the European Stability Mechanism can lend to countries at very favorable conditions. European Investment Bank and European Stability Mechanism are both located here in Luxembourg on Kirchberg, from where I speak to you. So these two institutions play a very important role in the recovery. Let me also mention another initiative which I find very important, which is the Coalition of Finance Ministers for Climate Change. I've attended again through teleconference the meeting a couple of days ago, where 52 countries are mobilized to make sure that finance ministers get the picture that they have a key role to play to make sure that we reach the ambitious goals of the Paris Convention. In fact, I've been lucky to be able to participate to all four meetings of the climate ministers since its inception 3 years ago. And I must say that the commitment of finance ministers worldwide is becoming very impressive. And last but not least, the third way to solve this complicated equation of climate change, sustainable development, sustainable finance, and in fact durable growth is digitalization. Now, if we really want to achieve the ambitious goals of the Paris Convention, digital technology is at the core of the issue. We've recognized that in Luxembourg. We've been paying a lot of attention to fintech over the last couple of years. You know that the Luxembourg Financial Center is the most important in the European Union, and fintech is one way how we're ensuring to diversify our financial center, make sure that our investment fund industry, which is the second largest in the European Union, can continue to thrive and to develop itself. And third, make sure that with digitalization, we reach the customers in a faster manner. Now, this being said, the European Investment Bank, which I mentioned already before, is a clear leader also in this field, as it has taken up the challenge of making sure that of all its loans, as the largest issuer worldwide, will be devoted to climate change to 50% by 2025. What an ambitious goal this is. And when you know the European Investment Bank, what you realize is what the bank is doing is crowding in the private sector. Because public help, public aid, public investment will not be enough to reach the goals of the Paris Convention. We need to have the private sector play its role. And how differently can you do it and efficiently than using the investment fund industry, which in Luxembourg is second to none. So I hope that you will have a good seminar over the day here, exchange views, because digitalization on the one hand, green finance on the other, is the key to solving the problems that we're facing today in terms of climate, in terms of recovery of the economy. Let's build back better together. Enjoy the conference.
Thank you, Minister Gramegna. So what you just heard was political will driving the momentum for sustainability and indeed putting mechanisms in place to facilitate and use the long-term benefit of the sustainability transformation. Now, on the other side of the Atlantic, you could say that this transformation is more driven by the market. You may remember in August, ExxonMobil, which is a leftover of the Rockefeller oil empire, was excluded from the Dow Jones Industrial after it was a member since 1928. For me, that sort of spells the end of the fossil fuel era. But how far does this will for change truly go on both sides of the Atlantic? And to answer this question, I have the great pleasure now to introduce to you
our next guest and keynote speaker, Bertrand Badré, CEO and founder of Blue Like an Orange Sustainable Capital, who will join
us now live from Washington. Bertrand is well known in development circles as former managing director and chief financial officer of the World Bank. Since stepping down in 2016, he's become a leading impact investor and also written a book about his insights called Can Finance Save the World? Regaining Power Over Money to Serve the Common Good. The book has a foreword by no one less than French President Emmanuel Macron and also the former Prime Minister of the UK, Gordon Brown, and is endorsed by the likes of Christine Lagarde and Mark Carney, former Bank of England governor. So, welcome Bertrand to the conference, and over to you with the question: do we seriously want to change the world?
Yes, hello, good morning. Can you hear me?
Yes, we can hear you okay.
Okay, well, it's 6 a.m. in Washington, so I'm not sure about the techniques. Thank you very much for your patience. Thanks, Judith, and thanks, Minister Gramegna, dear Pierre, for your very eloquent opening. It's a great moment to engage, and I'm very happy to be part of this conversation today. To answer briefly your question, Judith, I would say in a nutshell, the jury is out. But then it's going to be a little too dry. So let me dig into why the jury is out and how we can make the jury take a decision. First, let me start with a little bit of history. 10, 12 years ago, in 2007-8 till 2012, we passed what we call the global financial crisis, the worst in ages. The good news is that we survived. The bad news is that we have not really redesigned the system. We have just patched up the system. We worked on the ratios of banks, solvency, liquidity. We discussed prudential norms. So we've really touched at the margin, even if the margins were pretty important, the system that was in place. In 2015, so 5 years ago, we start to move a little further. We had a series of international agreements. Some you might remember, some you might not remember. The one seen from Europe is, of course, the Paris Accord on climate in December. If we move a little backward, we had the agreement in September in New York about the Sustainable Development Goals. And a little further back, in July, in Addis Ababa, in Ethiopia, we agreed on financing for development. So we decided 5 years ago, we tend to forget it, that we have a global and collective roadmap for a sustainable, resilient and inclusive future. We agreed on that. The problem is that, and I say that in the book you kindly referred to, is that we did not really think about the necessary adjustments to our financial system, to our model. And so we had generous and ambitious intentions, but we have not been to the end of the reasoning, trying to figure out what it would require financially to get there. And so when the COVID hit earlier this year, we were already off track vis-à-vis the 2015 engagement. I remember you kindly mentioned Mark Carney. In 2015, we both discussed the silent revolution in finance. We listed 400 plus initiatives which could transform finance. So we call it the silent revolution. 5 years down the road today, it's a little less silent, fortunately, but it's still not yet a revolution. And that's where we have a lot to do. So of course, we have green bonds, and I pay tribute to the leading role of Luxembourg from that perspective. We have social bonds. We have developed ESG socially responsible investments, sustainable investment, etc. All this is absolutely good, and all this goes in the next direction. But it's still, even if we talk a lot about it, on the face of it, it still remains, I wouldn't say marginal, but still peripheral. It's a nice to have, but it's not central, it's not mainstream. And this gap has been made more visible with the COVID. Of course, COVID is not a crisis of capitalism. COVID is not a crisis of globalization. COVID is not a financial crisis. But COVID first highlights the fault lines of the system, of our model, and also underlines the fact that we are not yet equipped to face neither, as Pierre Gramegna just said, the climate crisis, the environmental crisis, because it's not just climate, it's nature, it's a total environmental problem, as well as a social crisis. So I think the second point, the beauty, and it's very difficult to say we should benefit from the crisis, given the suffering that the crisis brings, that this crisis, this COVID crisis, provides us with an opportunity to discuss our operating system, our OS, as the computer scientists would say. What is at the heart of our operating system today? It's been put together exactly 50 years ago, in September 1970, by the great economist Milton Friedman, in a famous article in the New York Times. He wrote and explained that the only purpose of business was to increase profits. It was in the context, General Motors wanted to extend its board by having representative of the public interest, and he says this is just not possible. This is not the purpose of business. So we are driven by the fact that profit is becoming an end-to-end in our system, and we've built everything, every norms around that key principle. And now I think it's time to move further. If we are consistent with the commitments we made in 2015, we have to move to profit should not be an end to an end, but a means to an end. What do I mean with that? I'm borrowing the words from another great economist, Colin Mayer from Oxford, who says the social purpose of business is not to maximize profit. The social purpose of business is to find a profitable solution to the problem of this planet and the problem of its people. That's really what it is. It's not against profit, it's to link profit to sustainability and to long term, not just take the money and run. That means what I've said quite often in my previous book, we need to move from a world where finance is dominated by the capital risk and return, and we all know that, I think the audience is very familiar with that, to something which is a little bit more sophisticated, where you need to add a third foot to the equation and create the equilibrium between risk, return, and impact, or risk, return, and sustainability. That's, I think, what is the objective after COVID. Even if it's probably too early to speak of after COVID or post-COVID now. And that's where I think the jury is out. On the one hand, some people say that the world after, we've dreamt of the world after, is going to be the world before but worse. I still believe that the world after could be more inclusive, more resilient, more sustainable, as Mr. Gramegna just reminded us, in line with the commitment that we've made in 2015. So if we are serious, we need to really open the hood. We need to take our tools. We need to start working on the engine. What do I mean with that? It means working on the accounting standards, working on compensation policies, working on fiduciary duties, working on weighting methodologies, working on prudential ratios, and so on and so forth. And we need to discuss the financial models. Again, moving from risk return to risk return and impact, and really internalize a number of issues that we keep outside of the profit equation today. I think it's very important. And I believe that we will be forced to discuss our financial models anyway because of the interest rates. I mean, the models that were built on interest rates which were positive are probably a little bit challenged by the fact that we are likely to have zero, if not negative rates for a long period of time. And I think in that equation, there is a key role for Europe. And I really mean it, not just because I'm French, not just because I'm based in Luxembourg and also in Washington, but I think Europe has a genuine advance in that respect. I mean, we've worked on taxonomy, we are working on new directives today, and Luxembourg itself has positioned its financial system at the heart of these changes. It's really both a business issue and a sovereignty issue. It's a business issue, and you refer, Judy, to the Americans. I think the Americans smelled the business. The American got the business question first, I believe. They really believe that the extra financial dimension is critical, and just here the big leaders, I mean the BlackRock or Bloomberg of this world, as well as the small leaders, they are everywhere, and they have been bought at a fast pace, a number of European shops in that respect. So it's a business question, and we better fight for this. But it's also a sovereignty issue. At the end of the day, the people who will decide what is good or what is bad, what is right or what is wrong, will have a critical role. And I believe the Eurozone and the European Union have a particular responsibility in that respect, and will be backed, I suppose, by the ECB. I mean, the ECB is undertaking a strategic review. Christine Lagarde, with whom I work in Washington, has very clear ideas on that. So I think this is really the moment where Europe and Luxembourg can place sustainable finance at the heart of finance, not just at the margin, as I say in my introduction. We have also, and that's going to be my last point, we have to offer, and not only to turn ourselves to ourselves, but to discuss the issues with a number of emerging and developing economies. It's an amazing opportunity that we cannot underestimate. And I can't imagine we can miss it. And let me conclude with words from Tolstoy, the great Russian novelist in War and Peace. And he said, well, everybody wants to change the world, very few want to change themselves. And that's really the challenge we have ahead of us. We have also to change ourselves. It's not going to be business as usual. We have to make an effort, but I think it's really worth it, and we have all the tools in our hands. Thank you very much.
Thank you very much, Bertrand Badré, CEO and founder of Blue Like an Orange.
Sustainable Capital Live from Washington. So I think Bertrand there made a very good point. We need to push forward developing the sustainable finance ecosystem, and we now want to turn it over to our panel and discuss where are we in this process of developing the sustainable finance ecosystem, especially in light of COVID-19. What are the changes? What are the challenges? What else needs to happen? Tying in with the thoughts that Bertrand had just presented. And I have the great pleasure to introduce to you as moderator for this panel, my colleague Laura Meesendorp over
at the Financial Times. She writes about fixed income, including those green bonds,
from an institutional investor's perspective. And just very quickly, a reminder before I pass you on to Laura, remember those two digital tools you have below the stream window, the Q&A tool and the Slido polling tool that Laura will activate in a second. On that note, welcome Laura to the conference, and over to you.
Thank you, Judith, and a warm welcome to everyone who has joined us for this panel, looking into the future, a view from the industry post-COVID-19. I'm here today with Elena Filipova, Global Head of ESG Proposition at Refinitiv, a global provider of financial market data and infrastructure, who is also the rapporteur for the Benchmarks Group of the EU Technical Expert Group on Sustainable Finance. Also joining me from the UK is Michaela Simon-Howard, Sustainable Investing Strategist in the Chief Investment Office Wealth Management at UBS Global Wealth Management, with more than 15 years of experience in credit and debt markets. Last but not least, in the studio, Olivier Carré, Financial Services Market Leader from PwC, and one of the lead authors on a recent report on the growth opportunities offered by sustainable finance. Besides our panelists, we're also interested in your thoughts on sustainable finance. So if you'd like to join us on Slido, the digital tool that Judith just mentioned, we have a poll question for you. Sustainable finance activity seems to have accelerated this year. What do you think are the reasons? Are those A, COVID-19, B, incoming sustainable finance regulation, C, growing demand by millennial investors, D, a growing range of sustainability-themed products and services, or E, we don't see any acceleration? And we also welcome your other questions. Below the screen, you should see a little box where you can type in your questions, and we will answer as many of them as possible at the end of the panel. We encourage you to give your name, but if you want to ask questions anonymously, that's fine as well. We'll come back to our Slido results in just a moment. But first, Elena, would you like to tell us about sustainable finance and the progression you've seen in the past few years?
Sure. Thank you, Laura, and good morning, everyone. Good afternoon, good evening. It's an honor to be part of this important conversation. We've heard excellent keynote speeches this morning, and please allow me to build on some of the main points made and take the conversation one step further. Is shaped and informed and seen through the eyes of the data. Ultimately, what we see happening is both the public and the private sectors committing to net zero and moving to execution. The commitments came in already 5 years ago. They are becoming a lot more accelerated now. But execution is really the essence of the state of the plate as we see it. And execution will require using the Paris Agreement trajectory and methodologies, setting science-based targets, and setting transition plans and paths for the economy. The cliché saying that the goals will get measured, get managed, applies completely here as well. Businesses, investment professionals, governments need data to inform the execution plan, need to know their current starting point, assess different scenarios, set targets for the future, measure, and of course, to report progress over time. Data informs each step of the way, and the industry is moving towards greater transparency and, as a result, importantly, greater accountability, which is a much needed progress. Earlier this year, as the COVID pandemic was unfolding and paralyzing many economies, we experienced a significant degree of skepticism around ESG and sustainable finance, quite understandably, because of the belief and the argument that this agenda will be pushed to the side as companies, as industries struggle to survive. But what we've seen happening is actually the opposite. The pandemic has elevated the degree of urgency and scale to act on climate change, as well as other environmental, social, and economic risks presented to our society. It has also illustrated quite clearly how interconnected these issues are, and they cannot be tackled in isolation. We see a lot more momentum and acceleration, as mentioned by our keynote speakers this morning, in actions across Europe, but also internationally. And this acceleration in action is not only present in the public sector, led by the ambitious and comprehensive agendas of the European Union, China, New Zealand, Japan, and other nations. But we also see the private sector mobilizing and embracing the transition to low-carbon resilient economy as a prerequisite for financial stability and recovery. In the last couple of months and years, we have witnessed many bold commitments and initiatives from investors, from companies across sectors, and standard-setting bodies. Third quarter of this year, we actually was a remarkable quarter in terms of green bond issuance, and we saw an all-time record of more than $70 billion coming to market from close to 150 deals, including many multinational and multi-billion offerings from corporate issuers like Volkswagen, JP Morgan, Societe Generale, Daimler, and many sovereign issuers, of course. In total, the green bond issuance
I'm going to stop you just for 1 second.
About 150.
Your connection's a little tricky. I think we'll just move on to Michaela for a second. If you could put a headset in, that would be great. Because Michaela, we've heard Elena mention the bold commitments from lots of companies and large investors. And how is that in private wealth management?
Well, indeed. I mean, for us, it's a very important point, because when you think about private investors, what COVID-19 actually did is it made us all feeling our vulnerability a bit more. So basically, when you're vulnerable, you rethink your own life, you rethink your own strategies from an investment point of view, your future, etc. So looking at this actually means that when you look back a few years, so the incentives for an investment portfolio might have been a bit different, but now we actually ask new questions. Now we ask like, how sustainable is my portfolio? What is actually the companies I'm investing in doing to contribute to society? What are they doing with regard to their employees? What do they do for me as a customer? So as an investor, these are actually quite suddenly very important questions. So when we look at from a private investor perspective, I think it's more the transparency point of view, which is quite important for making these investment decisions. But also when we think a little bit about the historic background of sustainable investing, I mean, it's not new. I mean, we have this, so various different kind of strategies around for more than 100 years. But what we heard from Elena, but also from the other speakers before, is really that over the past 5 years, there has been a strong acceleration because we understand that basically exclusion strategies, which were quite dominant in the past, are probably not the way forward. So when we apply sustainable investing strategies, we are more thinking about integration, ESG integration, where you basically have a dialogue with the corporation, where you invest in companies which show that they are caring about environmental, social, and governance topics, and they are performing in that sense hopefully better compared to their peers. But it's also very important when we think about contributing to the Sustainable Development Goals, because I think that was a very important point with Bertrand made there earlier on. In 2015, it was basically the Paris Climate Agreement, which created a huge amount of awareness with everybody. It was amongst private people, amongst politicians, governments, etc. So it was really like a new roadmap which was given to us. And then having had suddenly the 17 Sustainable Development Goals, it gave us all a framework to talk about the same things. Because I think we have been talking about environmental topics, social topics, governance issues for a long, long time, but we all use a different language. We all talk probably partly apart from each other. But having the Sustainable Development Goals, it's actually a real, streamlined and easy tool for all participants to create new investment solutions. And this is probably what changed the most. So we are moved from a pure exclusion strategies, just basically avoiding companies where we are very sure that they do harm, to basically being a bit more precise and saying like, what do I actually want to contribute to? And which are the companies contributing to the factors which are at the core of my values? And I think this transparency, which we created, over the years now, and particularly since the 5 years ago, I think this is quite fundamental for private investors, particularly, to express their values, their thoughts, and what they want to contribute to society.
Thank you, Michaela. That's very interesting. And Olivier, we've heard both Elena and Michaela mention the need for transparency and for more data that investors really want to know what they're investing in nowadays. How do you see that in your industry?
The dynamics around sustainable finance, and that is something we really investigated in how we actually brought in the sort of survey and study you referred to, is to understand the new dynamics around that. And data transparency is largely driven, as done in previous sort of changes in the financial services industry, via regulation. So we had a number of voluntary standards, we had a number of labels that were in the market and that obviously institutions subscribe to, which are the PRIs, the TCFD, etc. of this world. Now, the big change in Europe and the big change of what we expect to unfold another dynamic in this matter is regulatory change that we have now ongoing here in the EU. This regulatory change will trigger a different stance and a different pace of change, and also the broad scale impact it has on the overarching industry. Now, Bertrand interestingly referred to as saying that sustainability is not yet in the mainstream. That is true. That is also our assessment. However, when we look at what is unfolding right now, there is going to be a lot of mainstream regulations in Europe that will be impacted and will be changed towards sustainability. Yeah? So we have obviously the new kids on the block, the taxonomy, as well as the Sustainable Finance Disclosure Regulation, which sets a new standard in terms of how to classify economic activities. So that's more for the investment side of the equation. And then we have the Sustainable Finance Disclosure, which actually sets a new standard in how to disclose, how to qualify, how to classify your products, and avoid greenwashing or ESG washing overall. So there will be a lot more binding standards around data and transparency around that. And that will be transposed into other regulations that are already existing, which is AFMD, UCITS, MiFID, IDD, Solvency II, CSD. So there's so much of the change will be ongoing. Now, this being said, and we expect when we look at the way the sort of market dynamics will take that up, that the sustainable finance assets, in this case the mutual fund assets, will grow up to about 57% in the best case, around 45% in the worst case scenario over the next 5 years, which is a tremendous compound annual growth rate, which stems from this regulatory change. But there are two other factors I'd like to mention before that complement that. The one has been already mentioned, which is the investors. So there's investor appetite, there's investor change of mindset around this. And we were quite surprised when we did the sort of a study and asked institutional investors in Europe of how far and how quick they want to change and how they see change in ESG converge. Actually, the results are that up to 77% of them expect to invest into ESG assets and disregard basically non-ESG assets for the year 2022, which is a very sort of short time frame. Now, we don't expect necessarily that to be 100% correct and accurate. However, the pace that we see is so much important that we believe that there is going to be a business opportunity here. Business opportunity that, again, was referred to both by his sort of former chairman of the UN, Ban Ki-moon, as Bertrand, as being one of the key levers of how the financial industry can contribute in this. Now, business opportunity doesn't mean we make money, only money out of this, but there's a level playing field that is set between financial indicators and non-financial indicators, sustainable indicators, that will determine whether a financial product, a financial sort of investment portfolio is actually seen to be suitable as well as up to the level that investors are expecting.
And Olivier, you've mentioned a lot of themes here in one go. So if we go back to the Slido, to the poll for a minute, which 120 of you have voted in, did the results surprise you, Olivier, or is this reflects exactly what you just said?
Well, that's good to see. It's good to see. I think the point, and eventually what you see is obviously the regulation now. So, I mean, we are looking at regulation, obviously here in this case, as a tipping point. There will be mainstream regulations changed. So that is definitely accelerating. Now, on the investor level, we saw, and we already sort of had evidence that there was an acceleration. It's even bypassing some of the deadlines we see in regulatory terms, which are largely converging around 2022, 2023, with a very first deadline now in March 21 around the products and the sustainable finance disclosure. And then interestingly in the poll is also the millennials. So the way retail investors are taking this up, the way they expect financial products to be sort of performing, and not only financially performing, but also having impact in that. And the way the asset managers bring the impact on their corporate level sustainability. This is a factor that we also mentioned and also indicated in our survey as being very strong. There's a change in societal views on what the industry and the overarching sort of investment and business purpose should be. And this will certainly also crystallize when we do take up those expectations in a more mechanical way by introducing sustainability in the MiFID framework, which is largely driving some of the retail investor sort of approaches in investment in Europe.
Thank you, Olivier. And Michaela, we see growing demand by millennial investors and the growing range of sustainability-themed products here, both very strong drivers behind sustainable finance activity. In practice, does this seem to be the case? Is it mainly millennials who are looking for these new products?
Well, it's a very interesting factor, actually. So what we find in our industry, so in wealth management, is that we have actually a changing client environment. So we see it coming from all sides. So the first movers were definitely the millennials. So because they have been a bit more progressive in basically asking for these kind of investment solutions. But now what we find also with a growing number of female wealth clients, it is actually at the core of their belief, because a lot of female clients are very value driven. They want to also understand a bit more what their investments mean, what is actually factoring, what they need to factor in, and also from a risk management point of view. So it's really like tailor-made for female investors, and the millennials are obviously very conscious about their future. They grew up with environmental, social issues, so it's very much at the core of their belief. But then if you look at the typical, I may say typical, but maybe older investor base, it's actually quite interesting because there's a strong shift in mindset going on. So what helps is various factors. So the first factor is obviously returns, because a lot of the investors are at the core of all investment decisions is still financial returns. So investors maybe were a bit confused before when we talked about sustainable and impact investing. They were confusing it with philanthropy. So it's definitely a completely different topic. So when we think about sustainable and impact investing, at the core of it should be financial returns, either equal or better compared to traditional portfolios. I think that is a very important point. And more investors understand this right now. And then when we talk to the typical elder generation, what we bring to the forefront is really this transparency aspect. We talk about risk management, because when I myself as a background is partly in the rating agency environment, of course, governance issues were always like a strong integral part of this. But now if we think about today, about modern times, and why, for example, sustainable development goals are so important, it's because of the connectivity, about the global environment we're in. We think about social media, etc., which bring these things to the forefront. But it also means that investments are at risk of anything which can be influenced by social media. And when corporations are not dealing with environmental issues, if they are not replying to social and governance related issues, that is out there right now within seconds, right? It's like maybe a few years back, it was easier to brush these things under the carpet. But now with the connectivity we have and the focus we all have on this, there is a strong reputational risk attached to it. So from a risk management point of view, I think this is a very important factor for all investors. And as I said, particularly our elderly or older generation is very much focused on this risk management aspects. But also we believe, and we talked about this before, and this speakers highlighted it, if we think about coming out of the COVID situation, when we think about the programs which have been set up now to recover, for the recovery of the economies, we are focusing on environmental issues, we are talking about social issues, etc. So we are talking about new industries we are going to support. So from an investor point of view, this is also very important, because when you invest sustainably, we believe that you actually invest in in sustainable industries of the future. And that will actually help to diversify your portfolio and to go with the kind of trends which are developing right now.
Thank you, Michaela. Elena, something that we keep hearing again and again is transparency. And I imagine behind transparency is, of course, data. How have you seen data develop in the collection of data? And is the risk of greenwashing nowadays? Is this something that worries you as a professional?
Yes, that's an extremely valid question, and I would probably take it a step further and say that the shift of capital towards the 2030 agenda for sustainable development and a resilient economic model cannot happen without better data standards and transparency.
I'm sorry, Elena, the sound is still quite bad. I'll throw this question over to Olivier and see if we can get it fixed in the meantime. Olivier, for the report that, sorry to throw that out there, the report that you recently worked on, how was data implemented there?
Well, I think the data issue and the way data is actually used in this regard is going to be key. Now, the fact that the sort of policymakers actually set a new standard with regards to transparency on the financial services industry, which almost anticipates, to a certain extent coincides with new data standards around taxonomy and non-financial disclosure regulation, which are more applying to the corporates inside the EU, actually creates a very tense dynamic between the different layers in an investment structure. So the corporate levels are not yet fully endorsing a new transparency standards, whereas already the investment levels are supposed to disclose and render transparent the way they invest into sustainable business activities, into sustainable investment opportunities. So there will be what we expect a tension between the two levels for quite a number of years. Data facility will be building, and NLNR obviously is one of the providers that are at the forefront in that regard since many years. Now, that is definitely something where there's maturity that the industry will expect, and that maturity will grow over time. So we are not yet there at the level of quality, the level of availability, the level of homogeneous data sets that we have for financial data. We are going into the right direction, and again, the way the different investor versus investment levels will work onto each other will probably handle this in a quite sort of rapid way, because there's a need to comply and there's a need to actually do that. Interestingly, and one of the key elements in data, which was also mentioned by Michaela, is the risk data. So there is a duty to not only assess the performance elements of sustainability, but there's also in particular the risk or sustainability risk as defined, an event that actually impacts the value of an investment linked to ESG criteria. And that in sustainability risk is one of the key findings as well that we believe is coming into play now. Right in this sort of new environment right now, the fact to invest into non-sustainable activities is not neutral anymore, because in the past it was always fine, and we had the example of ExxonMobil, which was mentioned by Judy. So this is actually something that was in the past neutral, and there was an upside performance opportunity, like for any investment. Now, with the change in the way actually those type of business and economic activities are handled in the taxonomy and from a regulatory perspective, this actually sets a downside risk on non-sustainable activities. And this is new. And when we listen and when we see institutional investors and some of the bank supranational investors actually move into sustainability, one option is to say, well, there might or might not be outperformance. Nobody knows that. I mean, there's a bet into a performance on that matter. There's obviously doing good, which is one of the key objectives to set at level playing field with the financial indicators. And the third one is to protect yourself against downside risk on the non-sustainable assets you have in your portfolio. And this third element is new in the equation and will require a lot of data, which is crucial in order to set your data and transparency right.
Thank you, Olivier. Moving on, Michaela, Olivier has mentioned doing good and mentioned protecting the portfolio. Do you see a difference here between investors in Europe and investors in the rest of the world, the US, for instance?
Well, not entirely. So I have to say that this is really like a global wave, right? I mean, for sure, in Europe, it has been probably a bit easier for investors because if you think about what is influencing your behavior or what is basically helping you to make sustainable investing decisions or in general investment decisions. And if you have like a framework, an environment where your government is very strongly backing sustainability, environmental issues, if there's a strong, fundamental belief in societies about these topics, then it makes it much, much easier for all participants, so particularly asset managers, banks, etc., to create these products, to provide these solutions, and also for investors to shop around and basically become very much involved in these kind of topics. So we have seen obviously a very strong fundamental drive coming out of the Nordic countries, but now we see it across whole Europe. But actually, if you think about it in the context of the US and also of Asia, there were different drivers behind it. Quite interestingly, I think we were all very shocked, like in a few years back when Trump the first time mentioned that he wants to exit the Paris Climate Agreement, and we thought like this would be disaster for sustainable investing going forward. But actually it did the contrary of it, because what happened is that if you have a legislation period where you have to wait 4 years to elect a new president or to confirm a president, but you can, in the meantime, actually make decisions on a private basis with your consumption patterns and with your investment patterns. And exactly that was what we have seen in the US taking place, that there was much more private initiative, that there was on the state part initiative, etc., which was driving this whole sustainability agenda forward. When we look at China, for example, or Asia, I think it's quite progressive. I mean, recently, obviously, the Chinese government has again put new kind of, targets into the space. But also, I think when you know that your industries are endangered by environmental topics, it's a very natural move that you want to protect this. And I think when you have investors in these parts of the world, they're very much aware of the situation, and they are actually quite forward thinking by protecting their own assets going forward. It's really like a risk management perspective for them, and also innovation opportunities are coming out manifold in these areas. So I think it's, yes, there is a big core move, particularly here in Europe, and we see it from a regulatory point of view, as we discussed it before, which helps a lot. But there's other factors which actually help investors to move into the similar direction by their own means on what they want to express with their investment decisions.
Thank you, Michaela. And on that interesting note, Robert, are there any questions from our audience?
Yes, we've got a number of questions. I'm going to aggregate a few questions on the topic of greenwashing, perhaps for the entire panel. Are there any industries or aspects of sustainable finance that are perhaps more at risk at greenwashing? And if so, which are these? And what can be done to stop the greenwashing that seems to be going on?
Helena, would you like to see if the tech problems are fixed?
Let's try. Technology doesn't seem to be on my side today, for which I apologize. Can you please confirm if you can hear me okay?
I can hear you.
Oh, really? Okay, that's excellent. Maybe let me just start off by commenting a little bit.
As soon as I said that, the sound went away again. I'm really sorry. Olivier, in the studio, perhaps? The risk of greenwashing.
Well, I mean, it's obviously a tricky question of whether or not we are facing more or less greenwashing. I think there's a business risk, so that if there's more attention, if there's more expectation, if there's more appetite from investors to receive and to be investing into sustainable products, that there's a higher sort of risk of investors and particular asset managers providing products that are not fully, in line with those sustainability standards, but pretend that actually do make a promotion of so. Now, the sort of counterbalancing of that is actually what the Sustainable Finance Disclosure Regulation in Europe foresees. It's actually imposing to the industry a new classification to say, if you promote a sustainability investment objective, or if you promote an investment objective which encompasses ESG characteristics, you are bound to certain very specific disclosure standards, both on the pre-contractual as well as on the periodic reporting, i.e. the annual report. And that drives a lot more transparency, a lot more consistency in what we see right now. So this is obviously providing for the baseline. There can be labels, there can be additional elements on top, but the baselining is already a product classification that comes by law. So this is not taking away a UCITS, AEF, or something alike, but it's just saying, well, I'm a UCITS and I'm in addition a Article 8 or Article 9. We'll probably have that in the industry jargon for quite a while in that regard. So there is a clear intention of the policymakers to make sure that this greenwashing is not taking over, that there's actually a counterbalance to it, and that the industry clearly articulates towards investors of whether they are following certain sustainability standards, and then there's a comply or explain, or whether they are not, and that means they cannot promote sustainability actively in their pre-contractual documentation and marketing documentation. They need to refrain from that. They can still invest into sustainability investments, but they cannot promote it actively without obeying to those transparency standards. So we believe that that is a quite strong statement that will take on some of those greenwashing risks that we have. Will we take away all of it? Well, probably not, but there is a very good way or very good path into the right direction.
That sounds positive and realistic. Robert, are there any other questions from the audience?
Yes, and there's a question directly to Michaela. There's an anonymous question to her asking, how many of your wealth management clients are putting sustainability criteria as their top priority? Is it more important than financial return nowadays to your clients?
Well, I don't have the actual figure how many of our clients are doing this at hand, but basically what happens is that the financial or the return aspects are still a very important part for, I would say, most of the investors. But anecdotally, I can tell you, I met a client earlier this year, and she was a bit frustrated. She said to me, look, when I talk to my client advisor always goes on about the performance of the portfolio. But what I'm really interested in is really about the societal impact and my values, that they are properly reflected in it. So I think we have to be a bit careful how we answer this question, right? So because it depends, first of all, on the individual investors. And we think that most investors really look three different kind of returns. They obviously want to have a financial return, they want to have a societal return, and a value-based return. But which at the forefront, what overweights is really a very individual criterion. So, but what we have done at UBS is, because clearly we have seen the trend, we do regular kind of questioning of our client base, etc., and we clearly see the trend that more and more investors really want to invest and actually want to increase also their investments towards sustainable investing. But going forward, and what we have announced as well, is that we want to make sustainable investing proposals at the core of the conversation with our clients, and we have actually only received positive feedback so far. So this actually gives you an indication that it is at the core or at the forefront of our clients to talk about sustainability issues and sustainable investing.
Thank you, Michaela. For the people who asked about greenwashing slightly earlier, Elena would add that the key to reducing the risk of greenwashing is having standards and the oft-mentioned transparency, both of which are being aggressively worked on in both the public and the private sectors. So that's very positive. Robert, do we have any other questions?
Yes, there are plenty, and so there's been some more follow-up questions on greenwashing, and now talking perhaps similarly on the green labels that exist in the market. There seems to be so many green labels in the market that it is confusing, and there's little clarity in between this. How could this be solved?
Michaela, is this something that you see your clients struggle with as well?
Well, I think we are as a service provider between our clients and the industry, right? So, and for us, it is obviously a struggle. And what we did, particularly when we started covering the green bond environment, so we actually took a partnership with the Climate Bonds Initiative, because we realized that although we are the biggest wealth manager in the world, and we are an asset manager and investment bank, etc., but still to have expertise in certain fields, it really needs partnerships. So to be able to define what is really green and what is responding to the standards we would expect from investments, we actually need to cooperate with different counterparts in the market. So at the point when we started covering the green bond environment, the Climate Bonds Initiative was really is still, in our view, one of the big drivers in that market to bring transparency to it, to grow the market. They have been part of the taxonomy groups, etc. So I think this is a very, very strong part of a necessary infrastructure we need in place to give assurance to all of us, right? So because the market is developing very fast, it has a strong outreach, and even we as the biggest wealth manager, as I said before, we are too small to capture it all. So strong partnerships is very important. And we see it right now is also, if we extend this to the development of the sustainable and social bond environment, because there we don't have these equivalents of a climate bonds initiative. So there is no private or like non-governmental initiatives around yet. So it makes it very difficult for all investors to actually assess and say, like, how strong is this social criterion these companies are proposing in their issuance information, etc. So I think it's all about partnerships, corporations, which will give us all the insurance and assurance that we are all moving into the right direction. And I think overall, and all speakers have said it before, is this is a journey. We are not there yet. This is still a developing market. And I think it's quite important that we all contribute to it. So we should not neglect it and say, like, it's not perfect yet, but rather say, like, okay, it's not perfect yet, but let's work all together and bring all our issues to the table and discuss where there are shortfalls and work to create an environment where we all feel comfortable and confident that we don't have greenwashing, or that greenwashing opportunities are highlighted, which makes it easier for us to make exclusion strategies on the base of that. So it's really about cooperation, transparency, and working together to make this all a successful future.
Thank you, Michaela. And Elena would highlight the importance of harmonization of reporting standards, both for companies as well as for investment professionals and their sustainable products. Robert, maybe time for one final question?
Yes, perhaps one final question that I'm going to merge two together again. Anonymous question is asking if institutional or retail investors are more interested in ESG and who holds the wealth. And then as a follow-up, is the taxonomy an adequate measure to increase the share of retail investors? Perhaps to Olivier?
Interesting mixed question. Well, I think the taxonomy actually is more related to classify the economic activities in the union. So that is more on the investment level that it will play, imposing certain common standards, screening criteria, as said in the taxonomy, that will set common standards as to what is a sustainable business activity, what's an enabling activity, and what's a transition to a sustainable activity. So the layer of the retail investors, institutional investors, actually not directly interacting with the taxonomy, it's more interacting with the Sustainable Finance Disclosure Regulation, which actually regulates the products as well as they're sort of directly pertaining regulations around MiFID, IDD, etc. So there's an additional layer into that. Now, will all of that favor a more sort of access, enabling, or interest of investors into that topic? I think there's a fundamental trend. Michaela and all the other speakers talked about that. But there's always a fundamental trend that sometimes needs to be picked up. And this picking up of this trend is very much so a duty, a task that has been given to the financial services industry, which sits somewhere in between the investment and investable assets and the investors, which hold capital either directly or in terms of fiduciary investors like pension funds and insurance companies. And we do see there that institutions obviously have endorsed quite significantly this topic. It's a major shift on their asset allocation that is already materializing, and we do expect that that will accelerate and materialize even more. And even the retail are now actively, starting 2022, asked by their financial advisors whether sustainability is a relevant factor in the way they would conduct their investment objective. And that is at least a minimum requirement which was not mandatory until now, but which makes and brings sustainability on the table in a structured way. And by doing so, the expectation we see from our clients working as financial advisors, so the wealth managers, the asset managers, as well as the financial intermediaries of this world, they are all saying, well, if we actively need to address that, first consequence will be there will be a large proportion of our investorship that says, yeah, values are important, as Michaela was putting out. And second, if we have that, well, we then need to take it up, and we need to have products in order to serve that particular new need. So there is a facilitation, there is a favoring of such a sustainable sort of investment idea and value-driven investment idea that is provided for in a more systematic manner. So it's coming back again to the mainstream impact we are seeing in Europe, at least, around this.
Thank you, Olivier. And with that, unfortunately, we have come to the end of this panel discussion. I'd like to thank all of our speakers, Elena Filipova, Michaela Simon-Howard, and Olivier Carré, and to thank everyone who attended and who asked questions.
Thank you so much, Laura Messendorf, and our fantastic panelists for this very insightful panel on where the industry is at.
We'll have a little bit of a wrap-up later on, because now we're moving on to a very special occasion. We cut to the Luxembourg Stock Exchange for a Ring the Bell ceremony in celebration of a, if you will, twofold historic moment, because the EU has stepped up for the first time as a serious AAA-rated bond issuer with the financing of its SURE unemployment emergency program with dedicated so-called SURE social bonds, and also when the first chunk of these SURE social bonds were issued last week to the tune of 17 billion euros, they were met with the largest bond order book recorded ever of 233 billion euros. You heard that correctly, 233 billion. So quite a historic moment. I have the pleasure to pass it over to our speakers. We'll have first up the CEO of the Luxembourg Stock Exchange, Robert Schafe, then the Commissioner for Budget and Administration, Johannes Hahn, and last not least, His Excellency, the Prime Minister of Luxembourg, Xavier Bettel.
Dear Commissioner Hahn, dear Prime Minister, ladies and gentlemen, dear all, and a special welcome to everyone who is watching us online today. It's a great pleasure for me, a great honor, to welcome you to the Luxembourg Stock Exchange, also the home of the Luxembourg Green Exchange, on the occasion of this extraordinary Ring the Bell ceremony to mark the listing of the European Union's very first social bond issued under the EU SURE programme. This issuance and this listing represent a remarkable milestone, not just for Europe, but also for sustainable finance. Today, we will hear precious insights from the CEO of the Luxembourg Stock Exchange, Mr. Robert Scharf, European Commissioner for Budget and Administration, Mr. Johannes Hannes, and Prime Minister of Luxembourg, Mr. Bettel, before we gather around the bell for a traditional stock exchange moment of celebration. So without further ado, I'd like to invite Mr. Robert Scharf to give some short introductory remarks. Robert, please.
Dear Commissioner Hahn, dear Prime Minister Bettel, ladies and gentlemen, during my 40 years career in capital markets, I have experienced a number of outstanding moments, albeit many linked to disasters and crises, unfortunately. Today probably marks the most defining moment and also a most joyful moment of my professional life, despite the current context. But as the old proverb goes, every cloud has a silver lining. I believe we needed to get into this sad and difficult situation to realize that we only have one planet to live on, a home which we share with future generations. And we can only overcome the current pandemic with all its economic, social and societal impacts by uniting our efforts in the broader solidarity movement of modern times. As financial experts, we focus on the well-functioning of capital markets. Therefore, we welcome the decision by the European Union to activate its 100 billion euros SURE programme, to raise funds to support member states in their efforts to secure jobs, hundreds of thousands of jobs in 17 countries. It marks the very first time that the EU taps capital markets with the issuance of social bonds governed by the programme rearranged recently under Luxembourg law. The response from the market can only be described as a resounding applause, with orders reaching the striking amount of 233 billion euros. Dear Commissioner Hahn, as a market professional, I am used to big numbers, but this left me flabbergasted. Capital markets judge Europe stronger than ever and are prepared to commit huge amounts of capital to support the EU in its efforts to strengthen the European economies and safeguard employment. This is a clear sign of investor support for the European project and the EU Sustainable Development Strategy. It shows that investors want to contribute to a more inclusive and resilient economy in Europe. The first tranches of 10 billion euros, respectively 7 billion euros, qualify as social bonds governed by a social bond framework and which bears a second opinion by Sustainalytics. We are honored to display these social bonds on the Luxembourg Green Exchange, the world's leading platform for green, social and sustainable financial instruments, founded by my colleague Julie Becker, which today counts more than 830 instruments totaling 320 billion euros. We established the Luxembourg Green Exchange 4 years ago as a contribution to the Paris Climate Agreement and the UN Sustainable Development Goals. Our objective is to facilitate sustainable investment and help reorient capital flows towards sustainable development. Today's listing marks an unforgettable milestone for us at the Green Exchange by adding these 17 billion of social bonds on our platform. And more importantly, I think it marks a meaningful victory for sustainable finance. The social bonds issued by the EU under the SURE programme will give a tremendous boost to sustainable finance market by providing depth and liquidity in an otherwise purely demand-driven market. Further issues under the SURE program will create even higher liquidity and possibly cover a broader range of maturities, thus creating potentially a full social yield curve from the EU. Ladies and gentlemen, what a defining moment for European capital markets, for sustainable finance, and for the ongoing ambitious Capital Markets Union project. The EU provided exactly what Europe needs to broaden its footprint in global capital markets and to be recognized by the international investment community as a must-have financial instrument. Let me close my short introduction by wishing the European Union well, that we will master the current challenges while laying the foundations for a stronger, maybe a better EU. I also heartily congratulate you, Commissioner Hahn, and your team for this resounding financing success, and we are honored to serve as your exchange of choice. And lastly, let me quote an investor who said on issuance day last week, "These are better bonds. We want more." Thank you.
Thank you, Robert. We are indeed living unprecedented times in the area of sustainable capital markets. I'd like now to welcome to the stage Commissioner Hahn, who will give us his vision for a more inclusive European economy. Commissioner Hahn, please, the floor is yours.
Dear Prime Minister, dear President, dear Mr. Schaufe, ladies and gentlemen, dear guests, first and foremost, thank you very much for hosting us today and also for your encouraging and reassuring words. And I think it could be really the beginning of a very long and hopefully very successful relationship. And that's why I'm very happy to be here today, indeed on the occasion of the listing of our first EU SURE social bond on the Luxembourg Stock Exchange. On the 20th of October, the Commission placed, as you already mentioned, 17 billion euro inaugural social bond under the EU SURE instrument. The issuance was a dual tranche, also you refer to it, with 10 billion euro having a tenure of 10 years and other 7 billion with a maturity of 20 years. The bond altogether was over 13 times oversubscribed, gathering a total demand in excess of 230 billion euro. The issuance was a full success, breaking many records. This was the largest ever issuance that a supranational and member state issuer raised on a single day, and the largest single euro-denominated issuance. The order book demand has hit all-time highs this year, larger than any demand for bonds issued by a member state in a single year, and it was the largest social bond issued so far in the European Union and in Euro. The greatest interest in it was a sign of the great trust towards the EU as an issuer and in the EU SURE and social bond framework. Once we have all SURE bonds or social bonds issued, we will triple the volume of social bonds on a global scale. If we issue up to 100 billion euro, as foreseen via SURE, this will result in social bond market tripled. This is another sign of the strong impact the European Union's financial policy can have on political priorities by directing investments towards a greener and more sustainable economy. Under these circumstances, the choice to list the first EU SURE social bond on the Luxembourg Stock Exchange has been natural. In the recent years, the Luxembourg Stock Exchange has gradually become, indeed, a hub for sustainable finance, and we are glad today that we can contribute to this role. More importantly, Today's move is one more sign of our well-established commitment to Luxembourg. Mr. Prime Minister, just a few months ago, we performed our first operation under Luxembourgian law under our program for macro-financial assistance. Luxembourg is also one of the home countries of the European institutions. We have an important part of our team working here, including the colleagues in charge of borrowing and lending, some of whom I can see here today. And I would like, if you allow, the opportunity to thank them for their great work done over the past months. Our success is only possible thanks to your dedicated work. The challenges ahead of us will nevertheless continue. We will issue over 900 billion euro in bonds over the period of the end 2026, with most of it heavily concentrated in the period 2021 till 2024. This is the highest amount ever borrowed in the history of the Union. The successful launch will definitely strengthen the international role of the euro and has established the Union with its AAA rating as a major player at the global financial markets. And may I say, it will also help to understand better outside the European Union what is the European Union. It's a political bloc, it's a political entity, it's a global player in political and economic/financial terms. And this is a challenge and a responsibility for us. And we are currently working hard to get, therefore, all the necessary elements in place. In the meantime, I am happy to launch the secondary trading of our SURE bonds, a true expression of solidarity and a step forward towards building a greener, more digital, and therefore more resilient Europe. Thank you very much.
Thank you, Commissioner Hahn, for these inspiring and forward-looking messages. The EU is indeed taking the lead in combating the social and economic impacts of this pandemic while fostering sustainable finance, a topic which is high on the Commission's agenda. And I learned this firsthand when I had the privilege to be part of the high-level expert group, which contributed to defining the EU Action Plan on financing sustainable growth in 2018. I would now like to welcome on the stage the Prime Minister of Luxembourg, Mr. Xavier Bettel, for his closing remarks. Prime Minister, the floor is yours.
Thank you very much, Madam Becker. Dear Commissioner Hahn, first to start, it was a very good decision. So to resume, I could finish now by saying that it was really a good decision to come here. And firstly, allow me to excuse Pierre Gramina, who would love to be here today, but who is not able to join. So firstly, I would like to welcome all of you to Luxembourg. For some of you, it might be the first time to discover Luxembourg. And it's really, I'm sorry for the grey weather today. Usually our country is famous also for weather conditions. This is firstly a response. It's a response to a crisis. And I'm very happy that we were able to give a fast answer to a crisis. We hit the world, hit Europe, and it's the proof that even being today in a stock exchange, where some people would love to say stock exchanges is markets, it's money. The bond is a social bond. And we give a social answer through financial instruments that we have. They are needed. And we were able to give, to show that Europe is a project of rights, but also a project of protections for our citizens, of social protections for our citizens. And let me congratulate dear Commissioner Hahn for the record-breaking of this issuance last week with a size of 17 billion. 17 billion. This issuance is the largest ever recorded by any supranational institution, and the Commission can be proud of that achievement. So I just told you good decisions, but also great result. And I'm convinced that the success also is due in no small part to the Commission's decision to issue SURE bonds, also as social bonds, as I just said before, to give a social answer through the instruments and also through financial mechanisms that we have. And for us, it was an answer to preserve employment, to invest in employment. The biggest mistake would be not to invest in existing jobs, because this bill will be not affordable for the next generations if we are not able now to give a fast answer, a quick answer, to preserve all the jobs. And that's the reason also why the impact, we see figures growing in some countries, but if we see in other parts of the world, we should be proud about these decisions that we took and the Commission to preserve jobs, because losing jobs will be the biggest social impacts in the next future, in the next month, in the next years. And so by establishing a social bond framework for this issuance, the Commission is paving the way for recurring issuance of this nature in the future. And it's an important tool to ensure transparency when it comes to the use of bond proceeds, and it will help drive markets standards too. And when Luxembourg created its sustainability bond framework this year, it had the same goal in mind. In this context, I would like to point out that my country reached a milestone of its own this year when it became the first European sovereign to issue a sustainable bond in September. It will thus not come as a surprise to you that my country fully shares the Commission's ambition to place sustainability at the heart of the European recovery efforts. We fully share also the Commission's goal to make the European recovery environmentally and socially sustainable, while also focusing on the digitalization of Europe. I want to thank it for the trust it has placed in Luxembourg to help us achieve also this objective. First, the trust you have shown by listing the bond on the Luxembourg Stock Exchange, which has become the global leader for green, social and sustainability bonds and has a long and close relationship with the EU institutions. Second, I'm glad that the Commission services based in Luxembourg have been able to carry out this landmark transaction. The well-established financial ecosystem in our country is perfectly suited for this type of operations. I am confident that the Commissions ought to take full advantage of the possibilities it offers when issuing bonds in the context of the Recovery Fund. Third, it is a pleasure to see that the Commission has followed the ESM in issuing its bonds under Luxembourgish law, which I take as another sign of confidence in the legal Luxembourg framework. And let me finish by thanking Robert Scharf and also Julie Becker and all this team they have shown in this sustainable finance. And this symbol is very important. And dear Johannes and dear Mr. Scharf and dear Ms. Becker, it is so important to show to people that being active in bonds at the stock exchange is not only thinking about today. With social issues, with environmental issues, we prepare the future. And making the opportunity to invest in sustainable economy, in sustainable products, is the future. And we see it, we for the moment, because of coronavirus, a lot of people think that we don't have any other problems. But we should not forget that our planet is still on the agenda. And to live a safe planet, a healthy planet, to the next generations belongs to the work and the decisions we take today. And by doing these sustainable goals, by respecting, by helping them to be to get to them, I think we showed as a country that we're not only proud about our past, but we know that if we want to be proud about our future, we have to take the decisions today. So thank you very much for the cooperation. Je me rhabille et je me rassieds. Hop là. Yeah.
Thank you very much, Prime Minister, for your encouraging comments, your long-term vision, and for supporting a sustainable recovery. We have now come to the defining moment of this Ring the Bell ceremony. And I would like to invite Commissioner Hahn, the Prime Minister and our CEO to please accept a hammer and join me around the bell for a moment of celebration.
So we can take it with us as a souvenir. Absolutely.
Yes, please.
It's mandatory.
Okay.
Thank you so much. You can take it in the council.
Ladies and gentlemen, with that, we will close the official ceremony marking the listing of the first 17 billion euro of social bonds issued by the European Commission. But at the Luxembourg Stock Exchange and LGX, we will continue to promote the sustainable finance agenda and help reorient capital flows towards sustainable investment projects. Together, we can create a more inclusive and resilient economy and a better society for all. Thank you very much. Have a great day, and please stay safe.
Thank you very much, Julie Becker there from the Luxembourg Stock Exchange. As you could see, you don't need the Wall Street to get a Ring the Bell ceremony made in Luxembourg in celebration of the first issuance of EU Sure social bonds. And just let me tie that in with our panel discussion earlier on, a very brief summary. So they all acknowledged, our three specialists, that we have seen a record issuance of sustainability-themed bonds, and these latest ones by the European Union are, yet again, is an issuance in the long line of green, social, COVID-19 and blue bonds and others. And there was the overarching agreement that the industry is indeed moving towards more sustainability products. They're developing the tools, more data and data analysis. And unlike a few years ago when the focus was a lot on exclusion strategies, what now is obvious that there is more a focused approach on the double return, so both financial and sustainable performance in alignment with the individual investors' values. That said, there is a bigger shift that's coming through in service, such as undertaken by PwC, among institutional investors, and this report actually says that 77% of institutional investors plan to stop purchasing non-ESG products by 2022, which is quite soon. And this big change is, of course, being driven by incoming regulation here in Europe with the taxonomy and the Sustainable Finance Disclosure Regulation. And as you could see, most of you agreed in the Slido poll earlier that this is driving, at the moment, sustainable finance activity. And just allow me to add, the runner-ups were in almost equal second and third place. Demand by investors, especially those millennial investors, and also a growth of products and services. And now allow me to link that in with what we can expect tomorrow on our second day of the 2020 Sustainable Finance Forum. Which further tools are in the regulatory pipeline beyond the green taxonomy that was already mentioned today? How do investors and asset managers respond to it? and what else may be needed to scale up sustainable investment. And we already touched upon that today with reference to international harmonization. Also, the question would be, should more countries follow the example of New Zealand, which made climate-related reporting mandatory from 2023 onwards using TCFD standards? So to answer all these questions, we'll hear directly from the European Commission and also representatives from the asset management industry, including Fidelity International, Federated Hermes, Columbia Threadneedle, and Dutch asset manager Actiam. So, to join us tomorrow, please do look out for your emails in your inbox, because this afternoon you'll receive a new link for the stream of day 2. Other than that, please do stay healthy and have a lovely rest of your day. Thank you for joining us today, and I shall see you tomorrow at 11 a.m. Central European Time for the second day of the 2020 Sustainable Finance Forum Luxembourg. Thank you.